Hey everybody, it's Wayne. I'm here with Hillary, and we're going to talk a little bit today about some terms that you might want to know if you are getting your mortgage, first-time home mortgage, first-time home buyers. So Hillary, what terms can you help us out with?
One of my favorite terms, I would say, is what we call DTI. That's your
DTI, what does that mean?
DTI is your debt to income ratio.
Why is that important?
It's really the entire formula of how we lenders qualify you for a mortgage.
Okay. So how do you do that?
So DTI, simply your debt to income ratio. When we are qualifying you for a mortgage, our main goal is to make sure that you're going to be able to repay that loan. So all we're doing is we're comparing your monthly debts, including this future new proposed mortgage payment, as it compares to your gross monthly income.
Okay.
So do you know what number we like to keep that DTI under?
40%?
It depends, but that's close.
Yeah.
Usually we can go up to a 45%.
Okay.
With some specialized programs, sometimes we can go a bit higher, but something that you as a client would want to think about if that's comfortable.
What does that mean, 40%?
So if we take a 40% debt to income ratio, we're taking your future proposed housing payment and we're adding your other recurring liabilities, typically which we're getting from the credit report.
Okay.
So things like car loans, student loan repayment, minimum credit card payments,
Okay.
all things like that that are recurring, child support and alimony.
So if all my monthly bills put together was $2,000 and my income was $4,000,
You're at a 50%
that's
debt
my
to income.
So my DTI is 50%. So then what kind of a loan would I be eligible for? A $2,000 loan?
So
Payment?
So remember, with that $2,000 debt, we want to include that mortgage payment into it. So if we know, for example, we're using a loan program that will allow us to go up to a 50% debt to income ratio, and let's say you're taking them out, looking at properties, and the mortgage payment will be around $1,500, well then we know that they're only going to be able to hold $500 in other debt.
Gotcha.
If that other debt's higher, then our first focus is on how do we scale that back.
Okay, that makes sense. So that's DTI.
That's DTI. So that's one of my favorite terms.
Okay. What's another term?
I would say another great term is LTV.
LTV. Is that a car?
It may be. But LTV is also your loan to value ratio.
Okay.
Okay, so if you are buying a home, typically, though not always, there's going to be some sort of down payment.
Gotcha.
Okay, so a down payment is just money that you as a client, for example, is putting into this purchase and you're borrowing less money. So if you're buying a home for $500,000 and you're putting a $100,000 down payment.
20%.
Correct, and look at you, I'm impressed.
Really
you
quick,
could take my job.
No, I can't. No.
So then that loan is only $400,000.
So the loan to value then is what?
80%.
80%. Okay,
80%.
that makes perfect sense. So like we were talking earlier, you don't always have to put 20% down. You can have a virtually no money down program. So what's another great term?
Well, you just brought up a great one.
Okay.
PMI.
PMI.
PMI. Usually the
I'm
term.
not going to guess on that because.
Well, usually PMI, people say that and they cringe a little bit.
Right.
PMI, it's also called private mortgage insurance.
Private mortgage insurance. Okay.
So private mortgage insurance is a typical insurance, but it only protects us as the lender in case you as the buyer were to default on your loan.
When do you get PMI?
You get PMI or mortgage insurance whenever you're putting down less than 20% on a home.
Okay. That
So
makes sense.
one interesting thing is that a lot of people hate the idea of paying mortgage insurance because, again, it's only protecting us.
Right.
However, we together have helped so many clients into homes without putting 20% down. I like to view mortgage insurance is what allows you as a client to buy a home before saving up that 20% down because it's not needed.
Right. So if you're buying a $400,000 house, you could be saving $8,000. See, I did math really quick. So that's PMI. What's another good term?
I don't know. Any other ones that you've heard come up?
So I'm always curious what's FHA and VA and conventional? What does all that mean?
So when you are taking out a mortgage, there's really hundreds of different ways you can structure that mortgage, but we like to segment the mortgages into a few categories.
Okay.
So I guess the two starting categories I would say are government loans and then conventional loans.
Okay.
Conventional loans, all those are mortgages backed by Fannie Mae and Freddie Mac.
Okay. Okay.
So those two institutions, in case you've ever heard of them,
Yeah.
they're the ones that really make up all of those rules. They really set those interest rates. They're more traditional mortgages.
So you have to follow Freddie and Fannie's rules in order to get a conventional loan.
Correct.
Okay.
So I would say that's the most traditional loan program, but also we understand that not everyone falls into that traditional category, right? So there are also government loans, so things like FHA, USDA, VA. These are three types of government programs. They, I guess, just really like acronyms.
So they're just, it's just an acronym, but it's a government-sponsored program. So FHA is Fair Housing Administration?
It's the Federal Housing Administration.
The Federal Housing Administration. I think I would know that. And then the VA is the Veterans.
Yep.
So and obviously there's great programs out there for VA and FHA, but I guess but we also have to consider that the property that they're getting is approved by both the FHA and VA property, right?
Correct.
So like if they're buying a condominium and it's not FHA approved, you can't get an FHA loan.
Right. And there's exceptions to everything, but for the most part, yeah, if you're using one of those government programs, there's usually a few more hoops to jump through, but it very well could be the best program for you. It could save you hundreds of dollars on a monthly basis compared to that conventional loan.
Perfect. And then I got a couple other terms I wanted to ask you about was, so somebody's getting a mortgage, there's different kinds of mortgages. Besides this, what's an ARM?
That's good. An ARM is also what we call an adjustable rate mortgage.
Adjustable rate.
Yes.
So when does it adjust?
So it depends. So there's two basic types of mortgages out there. You have your fixed interest rates. There are different loan terms and durations. Traditionally, we're talking about mortgages over 30 years. Adjustable rates, it depends on that mortgage itself. So for example, you can get a 5-1 ARM. Okay, what a 5-1 ARM would mean is that the first 5 years of you living in that property, the interest rate is fixed. Every year thereafter, the one of the 5-1, every year thereafter, the interest rate can adjust.
So if they got a 30-year 5-1 ARM, the first 5 years, interest rates say 3%. And then on the 6th year, the change, 6 through 20 through 30, it's going to change.
It could, yes.
And what determines the change?
It's just based on what the market's doing.
Okay.
So if you guys sometimes in the news hear about interest rates have decreased or interest rates have increased, a lot of that is tied to Fed interest rates, not necessarily long-term mortgage interest rates that we care about. Though people in adjustable rates, that's more something that you want to be attuned to and listening to, because that's going to affect your adjustable rate.
Typically, the rate goes up, right?
In our current environment, yes, because rates are so low to begin with.
Rates are so low to begin with. So why would anybody get an ARM?
Really, it's just if you're confident you're not going to be in this home for very long. I will say we see very few ARMs nowadays, just because fixed interest rates are so relatively low that
they are.
You know, we have, not to bore you here, but we have an inverted yield curve a little bit. So sometimes right now, ARM interest rates are actually higher than 30 years because the lender likes the ARM because they know that rates are likely going to go up in the future.
Got it. Okay. But there are things like a 10-year ARM. So if you think you're only going to be in the property for 7 or 8 years, then a 10-year ARM is worth looking at. And you can always add to the balance, right? Because typically the ARMs are lower, but you can always add to the balance to bring the duration lower or to build equity.
Yeah, so that's huge. That's actually one of my favorite conversations with clients, where we look at an amortization table. And I know I just sounded like such a nerd. I love my amortization tables, but that's something where it's going to break down the next 30 years or however long your loan is. And it's going to show how much money is going towards principal, which is just lowering your loan balance, how much is going towards interest. And if you chose to pay more towards your balance, if you want to throw an extra $200 a month to pay off your mortgage sooner, it will show how much interest that will save you over the life of your loan.
And so an amortization, what did you say it was? What's the amortization?
Schedule. Or table.
Okay. That's just a table that shows all the payments and how long it takes to pay it off and everything.
Exactly.
And then you do a comparison of this to this if you add $50 a month or
exactly.
Perfect.
So you know, we always want clients thinking about the best use of their money. So if you have a car loan at 6% and a mortgage at 4%, we don't want to throw extra money towards the mortgage. We want to get rid of that car loan first. But once the other debt's wiped out, sure, throw it into the mortgage.
Perfect. Okay. Any other terms that
I think that's a pretty good amount of terms.
It's a pretty good amount of terms. So I think this is Wayne, this is Hillary. Thanks for watching. We hope you didn't get too bored.
Hope to hear from you soon. If you think of any terms that we didn't cover, just let us know.
Yeah, and also if you're looking at my YouTube channel, you can ask in the right here. You can ask any questions you want, and we'll answer it for you.
There you go.
Okay.